everything that we reviewed so far. So we're going to go back to the PowerPoint, okay? And I want you to stop me whenever you have a question, okay? PowerPoint. So basically what we did is we spent last week introducing aspects of accounting. And a couple of the things that we really focused on related to what is an asset, what is a liability, and what is owner's equity. So we're going to just go and review some of the information. We first talked about in accounting, we measure things. And we measure things by taking various transactions and figuring out what's being measured, when it's being measured. Do you remember that? How it's being measured. And so accounting has to do with measuring. We started talking about business transactions. Business transactions are economic events. Remember we said that economic events change the financial condition of a business. Not every transaction is necessarily an economic transaction. If I go and say, Melissa, I want to hire you, is that an economic transaction? Did money exchange? Or did any value exchange? No. But when I pay Melissa a salary, is that an economic event? It changed the financial condition. So we just began briefly discussing economic transactions. And we talked about in the United States, we measure money in the form of a US dollar because that's how we all get paid. We identify, what does this iPad cost? $500. I don't know how many rubles it is, but I know dollars. How much was this Diet Coke? $1.50. How much do you get paid in a month? Do you see how we use dollars? That's how we measure in accounting in the United States by dollars. Then we spent more time talking about how every business is treated as a separate entity. And what we were explaining in that is the business operates and we record the economic transactions for that business. But the person who owns that business, we don't record their personal transactions within the business, do we? We treat the business separate from the individuals who own it. Do you guys remember us talking about that? Ask any questions. You can stop any time. Then we started talking about the term asset. All an asset is an economic resource that's going to have a future benefit. So, cash. If I have $500 in cash today, is that an economic resource? It is, because I can use that cash to do a lot. And the reason it's going to have a future benefit is because I get to use it to buy something. Does that make sense? This iPad, is this an economic resource? It's helping me. Does it have a future benefit? Is it going to be worthless after today? No. I'll be able to use it tomorrow and the next day and next month and next year, hopefully. Do you see how this provides me with substance that I'll get to use in the future? This piece of paper, that piece of paper, let's say, I'm writing, I'm taking notes. It's a piece of white paper. Am I going to use it up today? Yeah. Is it going to provide me with a benefit next year? No, it's a piece of paper. So it gets used up. That's an expense. I'm not going to see that anymore. Does that make sense? Assets are items that are economic resources that are going to provide me with a future benefit. And we're going to talk about some, okay? Then we started talking about liabilities. These are business obligations to pay cash, maybe transfer assets, or provide services to other entities. The key here is in the future. Okay? So, it is an obligation to do something in the future. So I gave you an example that I bought an RV. Let's just say this RV is from this business, Nancy's traveling companion. And I purchased an RV for the business. Does that RV, is it an economic resource? Do you think I'm going to be able to use it next year? It's an asset. Okay? So when I went and purchased this asset, the asset, say I purchased for $50,000. I had $10,000 of my own money, but I didn't have all of it in cash, so I had to take out a loan. So basically the loan at Wings went to buy my asset. But I owe Wings that money, don't I? That $40,000 I owe Wings, do you see how it is a business obligation? I am going to owe them $40,000, and I'm going to do that by giving cash to them in the future. Yes?
So the liability is the bank for the loan?
The liability is the loan. Does that make sense so far? So what I'm doing here is let's just take one thing at a time. The liability is the loan. An accounts payable is a liability. In that case, because I'm not going to pay that $40,000 back in 30 days, it's really going to be a notes payable because it's more like a loan and note. Let's say I needed to borrow $500 and I'm going to return it in less than 30 days. Then it would be an accounts payable because I'm going to do it quick. But $40,000 is a lot of money for my business, say this business, and it's not going to get paid back in 30 days or 60 days or even this year. So since it's going to take longer than a year for me to pay back, I'm going to make it a note payable. Does that make sense? Correct. Exactly. So usually accounts payable have to deal with supplies. So if I go to Office Max, spend $300 in supplies, and they send me a bill, I've usually got 30 days to pay that bill. So that would be an accounts payable. I owe them money, and that would be an accounts payable. But an RV loan that's going to take me 5 to 10 years to pay back is more a long term. It's going to take more than a year. Usually things that are under a year we call current. They're in the current period. But if it's going to take longer than a year, we're going to make it a long-term note is what we're going to call it. And again, you're asking really good questions. And I think that's why you're going to be a good student, but you're thinking too deep. But that's, I mean, you know what I'm saying? We all work a little differently, how we comprehend things. So yes, we're going to make that a different type of liability because of its length. Next, so then we said accounting. It's an information system. We go through processes of measuring and communicating this information. And a couple things, we provide information regarding a business entity separate from the owners. Or Remember I was telling you about my husband is a photography business and I have a CPA practice? We don't combine the two, do we? We keep his photography separate from mine because they're both different entities. Okay? Then we started talking about why do we need accounting? Well, this whole processing we do needs to happen because there's all these different business activities that we're going to need to pick apart, and we're going to need to take this information, we're going to measure it, we're going to process it, and we're going to communicate it, and we're going to hand that information, financial statements, off to people that make decisions so we can do it all over again. So it's that information that they're going to gather to determine, hey, we need to produce more of this kind of widget because that's making money. Or they might say, we need to get rid of this line of work because we're not making money. Does that make sense? Or maybe they say, hey, we need to increase our sales in this and charge more. So any type of decisions like that get made because of the data they're looking at that helps them make those decisions. Does that make sense so far? So we talked about financial accounting and managerial, just saying this class is about financial accounting. We're going to gather information so we can give it to external users, banks, stockholders, people that may be investors, to help gather information. Then, don't worry about any of that. The key when we deal with various transactions is to record what, how, when, where, the various ways we're going to decipher various economic events or transactions. So we talked about transactions. They could be we purchase something, we sell something, we collect money, we receive a loan. There are various exchanges that alter the financial condition of a company. So let's just say I didn't have any transactions today, but I went to the bank and took out a loan for $2,000. Did that loan alter my business? Yes. It didn't give me a sale, okay? But it brought in more cash. That loan, I increased what I owe to the bank. But I also increased my cash on hand. So do you see, even though a sale didn't happen or I didn't go and purchase anything, but it still changed my business because I brought in more cash. How? Because I increased a loan. Does that make sense? Correct. The accounts payable went up and my cash went up. Does that make sense? Let's think of another transaction. I did a tax return today for $200 and they gave me cash of $200. When did it happen? Today. That's when. What happened? What increased? Cash increased. What else increased? Sales. Cash is an asset. Okay? So cash is increased, which is an asset, and sales increased. I earned money, didn't I? Make sense? Let's think of something else. Today is September 2nd. I had to pay the rent of $3,000. What happens when you pay rent? You write a check, don't you? Now, I don't own this building. I just pay rent. $3,000 a month. Am I going to have anything to show for it after the month's over? Not a damn thing. It's frustrating. It's actually $3,300 a month. Isn't that crazy?
Yeah.
But it's an expense. Why? It is providing me with something, but I'm not going to see any benefit down the road, am I? I'm using it just like you lease a car. You use it and it's used up. Just like that piece of paper. You use it, it's used up. Make sense? What's another transaction? Yes.
Well, maybe we'll get to it later. Between supplies expense and supplies and assets.
Basically, what happens is, let's say we go and we purchase $500 worth of supplies. Did we use it up today? No. So we keep it as an asset until we use it. Does that make sense? So does it help you guys understand there are all kinds of transactions? We can pay our rent. We can provide a service. How about this one? I did a tax return. I gave them the return, but they said they would put the check in the mail next week. What event took place today? A sale. Did my cash increase? No, but I gave them an invoice and I said, you owe this. I'm going to receive it. They need to pay me. So my sales went up. What else went up? Accounts receivable. Because they owe me that money and I should be getting it soon. Okay? Next week, I get a check in the mail. What happens now? What happens to my cash? It goes up. Am I going to get that accounts receivable anymore? It got paid. So what happens to accounts receivable? Does it make sense? Every event we can measure and we can decide which accounts are affected, how much is it affected. Does that make sense? So transactions we are going to go through and process. A transaction can be an economic event that doesn't involve an exchange. So what they're trying to say there, this really happened to me in a building. One day, it's a Saturday night, we have this huge windstorm. So I'm sitting with my kids inside our house, just, looking outside going, wow. The next morning I get a phone call from my landlord. They say, our building's been destroyed. The windows in your office got knocked through and you need to come and see what damage happened. I walk over because at that time my office was like 2 blocks from my house so my kids could get off the bus and go there. I walk over. Oh my gosh, water everywhere, tar all over the place. I'm looking going, oh no, what do I do? Computers ruined because they got water all over them. Did an economic event take place? Now, I didn't necessarily do anything, but guess what? I just lost a bunch, didn't I? I lost assets because of just this straight line winds. Make sense? I had a client last week. I met her after class, or on Thursday. We were together on Wednesday. Did you guys hear of this airplane accident about a month ago that happened in Hudson, Wisconsin? Anyone hear about it? This was my client. He owned an airplane. He was going flying with his friend and their 2 sons. Well, they were up in the sky flying, and they don't know what happened, but it crashed. And he's gone. And so let's just say this was a business where he flew people around. So he didn't get the revenues yet, Maybe he was expecting to get revenues. It really wasn't a business, but let's pretend it was. So, did an economic event happen? Yeah. What? His airplane is no longer. It's not as though his airplane's no longer because he used it up. His airplane is no longer because it was an accident. Do you see what I'm saying? So, what are we going to do to record that accident? We're going to have to get that airplane as an asset off the books, aren't we? Fortunately, we're going to get some insurance to pay for the loan on the plane. You see what I'm saying? So when the insurance comes in, we're going to have to show that money coming in, and then eventually we're going to have to show that money going out, and reducing our loan on that airplane. You get what I'm saying? So even though we didn't really mean for that to happen, it happened. Make sense? Think about 911 and the World Trade Center. I mean, or it doesn't even have to be that drastic. I mean, think about what happens when we get a bad tornado around here. Nothing changes, but everything changes. So it does become an economic event because it changed our financial situation without expecting it. Another type of transaction that happens just through time is what we call depreciation. I think I was talking about these tables. When we buy this table, we expect it to last for 5 or 10 years. But it's not going to be as perfect as when we buy it right away. You know what I'm saying? It just gets old after time from wear and tear. So one thing we record as a business is something called depreciation that shows each period the wear and tear on assets. So we can kind of take a little bit of wear and tear each year as we're using it up. Does that make sense, guys? Then we talked about it all is in the form of money, which in the U.S. are dollars that we can relate to. We then barely talked about various types of entities. I'm not going to get into that in this class. So then from there, we spent some time talking about this accounting equation. Do you guys remember? The accounting equation is assets equal liabilities plus owner's equity. And basically what we're trying to say is all economic resources that will provide a future benefit are either obtained because the owner uses their own money or we borrow money. Make sense? We receive resources that will have a future benefit because the owner contributes or we borrow. Okay? So we were talking about, let's take my RV. My RV of $50,000. How did I get it? How much money did I put in? 10. How much did I have to borrow? Which is the liability? What I had to borrow. What's my owner's equity in it? The 10. Perfect. Does that make sense? So assets will always equal liabilities plus owner's equity. We talked about assets, economic resources that will provide a future benefit. Assets include cash, different types of investments, inventories. What is an inventory? It's the product that's being sold by a company. So with Office Depot, what is inventory? The resale merchandise, isn't it? The computers and the printers and the paper cartridges and the paper. That's their items that they're selling to make a profit. What would be Honda, Luther Honda. What's their inventory? Vehicles. Because they aren't keeping those vehicles to improve their business. That's what they're in the business to do, to sell vehicles. Okay, so that's an inventory for them. Land can provide a future benefit. How could land provide a future benefit? Let's think about it. Let's say I'm a farmer and I have a bunch of pasture land that I grow crops on. Does that land, it's an economic resource, what kind of future benefit is it going to give me? Crops. I'll have the ability to grow crops on that for a lot of years, hopefully. Okay? What about Honda Luther? They go, Luther Honda, they go and they purchase 5 acres of land up in Forest Lake because they're going to build another auto dealership there. Is that land going to provide a future benefit? Yeah, because they're going to put an auto dealership on there. Is that a benefit? Yeah, they're going to be able to sell cars on that land. Does that make sense? So we've got inventory, an economic resource that provides a future benefit. We have land, buildings. Well, equipment. So buildings are what hopefully house the offices that allow a business to be conducted. Let's say Luther Honda spends $2 million to create a, what do you call the inside? Where you have the nice cars. Thank you. Showroom. Is this building with this showroom going to provide a future benefit? It is. It's an economic resource that's going to last more than a year that will give us a future benefit. What's the future benefit? Bringing in clients to look at the cars to eventually purchase the cars. Does that make sense? Equipment. How can equipment provide a future benefit? Well, let's say I drive around to various clients and I require an automobile to drive to the various clients to work on their taxes. Let's just say. This automobile, is it going to last just for the day or the month? No. It should last for years. With my husband, they last for 15 years. 250,000 miles. It's like, okay, let's get a new one. But the good news is they do last for a while. So is this automobile going to provide me with a benefit next year and the next and the next? Yeah. What's the benefit? I can drive around so I can make money. Does that make sense? You have a landscaping business. You need lawnmowers. You need edgers. You need snowplows. Why do you need that equipment? To do the job, to make money. Do I need one lawnmower every time I mow a lawn? No. That lawnmower can last me probably 5,000 mows. So do you see how that's a resource I have that's going to provide me with a future benefit down the road? It's an asset. But now I have some ink for my computer printer. And I went and spent $70 for one cartridge. And that cartridge is going to be no good in a week. Does that provide me with a future benefit? It's going to be done in a week. Okay? It's an expense. Why? Got used up. Make sense? Salary. Melissa works for me. She spent the past 2 weeks working 80 hours. I wrote her a check for $1,000. Do I have anything to show for it in the future? She put in her hours. She got paid for her hours. It's an expense. It's all used up. Make sense? What about, sweetheart, you are a huge asset. But do you understand that transaction of paying her that money, am I going to see a future benefit from it? No, I paid it because of the hours she worked. Those hours are gone. It's an expense in the current operating period. Let's move on. There are times that we may have assets, but you can't really see them. So I have a daughter who is very interested in the latest and greatest kind of cancer drugs out there. Why? Because she has cancer now, and we don't care about the drugs that were made 2 and 3 years ago for cancer. We want better and newer. You see what I'm saying? Because we're hoping research has improved that's going to zap this stuff. So someone creates this amazing drug that's going to cure all kinds of cancer. There's some value in that, isn't there? But you see, this wise guy is going to sell it to Medtronic for $5 million. What's he selling? He's selling the ingredients in the recipe and the approval from the FDA so Medtronic can produce this drug and sell it. But what is it they're buying? Are they buying a building? Why are they going to spend $5 million on what? It's got value, doesn't it? No one else is going to be able to sell this drug. They're the only ones. That's got a lot of value. So they're willing to pay for it to get the rights to be able to sell it and market it. But you can't see it, but it still has value, doesn't it? Even though you can't see it. That is an intangible asset. The trademark, the patent, the copyright to be able to use something. Make sense? Kinda? Then we talked about liabilities. Those are business obligations that are going to require something we need to do in the future. Either give them cash, provide some services. We got to do something to make them happy, to fulfill our obligation. Those liabilities can include amounts to suppliers for goods or services bought on credit. So Office Depot, we received supplies. I owe them $500. That's an accounts payable, right? How about my attorney created an employment contract? He's provided me with this service, so now my employees are really, I got them kind of down pat. I've explained the who's, the how's, the what's, the where's. Here's your agreement. But I had to hire someone to make this for me. He provided me with the service. He gave me the employee contract, but I owe him $1,000. Do you see that amount I owe him, because I haven't paid it yet, is in accounts payable? Okay? Accounts payable, those amounts owed for goods or services. Now, when we deal with the RV loan, that's money I borrowed from a bank, and I can't pay it back within 30 days. So those are going to be liabilities. They might be called notes payable or mortgages payable, depending what it is. But it's current obligations, that money I owe, that's going to require me to give them cash or something in the future. Does that make sense? Then we've got salaries and wages. Okay, Melissa worked for me. She did a great job, 80 hours. She got done last Friday, but I'm not paying her till tomorrow. Okay? So, did her work already happen? It becomes an expense when it's transpired, when it's transacted. Did I pay her yet? No, I'm paying her tomorrow. Do I owe her right now? Yes, as of Friday, I owed her $1,000. Okay? So the minute I can record she worked, it's used up, that's an expense. I could have paid her right away, and that would have reduced my cash, but I didn't. The agreement is I pay her on Thursday. So right away, I have a payable. I have an obligation to pay her, don't I? She provided something for me. I owe her. Does that make sense? So that would be a salaries payable, wouldn't it? Then, oftentimes, we owe taxes to the government. Money we know we owe, we haven't paid it yet, taxes payable. There is something else that can happen. Services we haven't yet performed, but we need to perform. So let's say I am doing an audit for someone. But they've contacted me and they want me to perform this audit. It's going to take place over about 2 months. I say, well, you need to give me $2,000 up front. So they bring in $2,000. What happens to my cash? It goes up. But have I done a sale yet? No, I haven't. I'm not going to do it for 2 months out. So what do I do with this cash I received? Have I earned it yet? I really haven't earned it yet. I'm planning on earning it 2 months later. See what I'm saying? So really, I receive cash for something I haven't performed yet. It's a liability because what happens if all of a sudden the audit gets canceled? I owe him his money back, don't I? Do you see how services that have not yet been performed can be a liability? I got the money, but I haven't performed the services. I need to. Do you see how a liability is an obligation that I need to either pay in the future or do something in the future? Does that make sense? That's another form of liability.
So then when you do it, then it'll become a sale.
Correct. And what happens to the liability? It goes away. Exactly. Take one transaction at a time and just look at that event. Getting that cash for something I need to do in 2 months, what's that? My cash increases, but what's over here? A liability because I still need to do it. Then the audit's performed. I'm done. I'm showing income of $2,000. Am I going to get cash? No, I already got the cash. I can then reduce my services deferred.
So then you would move the cash to the
Cash already happened. So the cash doesn't, I didn't change any cash in that transaction. That liability of services to be performed now are performed. So I don't have any more services to be performed. I can get rid of that and show my sale. Does that make sense?
So it's no longer an obligation.
Correct. Correct. It's a sale, but now instead of it being an obligation, I get rid of that obligation. Each transaction, we look at that specific one. There will be many more, but the job of accounting is to take each transaction and look at it and determine what's going on. Then we started talking about owner's equity. These are the claims the owner of a business has on the assets of a company. It's like what's left over, okay? It's what's left over. Owner's equity is what's left over after we pay out all the liabilities. Sometimes we call it net assets, which is, I think, how you get confused because they kind of intermingle words here. You see, Melissa? So basically, it's what's left over, okay? Owner's equity, you know how we were talking about assets equal liabilities plus owner's equity? Well, we can say owner's equity equals assets minus liabilities, okay? So my poor client who doesn't have an airplane. No, that's not a good example. Okay, let's just say the airplane isn't once what it was. We can probably sell some wings and maybe some electrical stuff. And so we have $5,000 of assets. If they owe the bank $2,000, what's left over? What's she going to get? The difference. Do you see the residual? But let's hold on that. I don't want to freak you out about owner's equity yet. We talked about how with owner's equity, it's a continually changing figure. The first year we go into business, we have investments into the business. We can add our revenues that we made during the year in the business. We subtract withdrawals or things we took out of the business, cash we took out. And ultimately, we end up with an ending balance. The revenues increase our owner's equity. The expenses decrease our owner's equity. But whatever the net income is goes into owner's equity. If we have a net loss, that reduces our owner's equity, doesn't it? Because that means we got to deal with that excess expense, so we didn't make any income. But whatever is left is ultimately what our ending balance ends up being. So we went through this example where we kind of tried to look at how do we determine owner's equity. Well, we always know assets equal liabilities plus owner's equity. So if our assets are 140 and our liabilities are 60, what's our owner's equity going to be? It has to be 80 because assets equal liabilities plus owner's equity. Does that make sense? So it's telling us during the year, the owner put $20,000 more into the business. Then throughout the business, he needed money to live on, so he took 24 out. What was the net income of the business? We don't know. But we can solve and figure out what the net income is of the business. How? Because if it tells us at the end of the year the assets were 200, the liabilities were 70, what does that mean our owner's equity has to be? The difference. So if we know everything else, the beginning balance of owner's equity, the investments, all these things, can't we figure out what the net income is? Do you see how we can solve for it? 80 plus 20 is 100. Plus 124 is what? 124. Our end of year is 130. What does that mean the net income had to be? 6. I don't have my calculator on me. Does that make sense? So that's where we're going to go through problems after problems to help cement that information in. Then we talked about 4 financial statements that are really important. I think I told you we're not going to even deal with the statement of cash flows. But we're going to talk about the net income statement or the income statement. And we talked about that's kind of the first one you have to do. We've got to figure out what are our revenues and what are our expenses. What's the difference between revenues minus expenses? Net income. So our income statement is really the statement that summarizes our revenues minus our expenses, or our sales minus our expenses. Okay? In my business, it might be all the tax returns I've completed, sales, minus all the expenses like rent and Melissa's salary and all my office supplies that I've used up, and. Okay? That's it. I don't care how much cash I have in the bank. That's different. That's an asset. Right now, I'm just wondering how many dollars of sales did I create this year? And how many dollars of expenses do I have? Don't think about but how much money came in, how much money went out. That's what's unique about accounting. We are what we call a double entry system. We're not talking about money coming in, money going out. We're talking about sales made. How many people have I created revenues from? and how many dollars has it cost me to run this business. That's it. Okay? So the income statement is really, it shows, is the business profitable? Did it, when I say make money, did it increase its net income or did it have a net loss? Revenues minus expenses equal either net income or net loss. Does that see? Then, so we were looking at various income statements. I was trying to give you little hints of the important thing here, and the only thing you're going to see are revenues, and you're going to see expenses. And I told you, an expense you can figure out because what is always in an account that has an expense? The word expense. Isn't that helpful? So the accounts we're going to use are only revenues or fees earned and then expenses, and that's it for the income statement. We don't care about cash. We don't care about liabilities. We don't care about that stuff. The income statement only are revenues and expenses. Then we were talking about that statement of owner's equity. We have to do the income statement first before we do the owner's equity statement because we have to know what the income was. Because that net income or net loss we need in order to figure out how the owner's equity balances. Remember that? Income statement first, then the statement of owner's equity. The statement of owner's equity really shows the beginning balance of the claims left for the owner. We get to add to it investments they've made, net income they've made. We'll subtract money they've used, they've received from the business, that they took out of the business. If there's a net loss, we're going to have to subtract that. We're going to have an ending balance in it, aren't we? That's the statement of owner's equity. It basically shows us the change during the period of the owner's claim on this business. He started with no money in the business. He invested $200,000 throughout the year. He made some money during the business and took some money out. So he started the business with zero, but his equity or his claim in the business at the end of the month is $206,000. Now guys, no, 200 of it is because he put 200 in. 84 of it is because they made net income, but he took some of that net income out. Does that make sense? So that's the next statement you have to do. Then the balance sheet is the last statement that we care about right now. That helps us see the financial position of a company. Assets equal liabilities plus owner's equity. Remember me saying that it's a snapshot? Remember me telling you on a Friday morning when I just get paid, I might feel real good about myself, but 10 minutes later, is my situation the same? No. So at one moment I might go, oh, I have $20,000 sitting in my bank account. 10 minutes later, after I pay all my bills, I'm sitting with $300. It's a snapshot. A balance sheet is just a snapshot in time because the next minute it's going to change. Okay? Where an income statement is over a period of time. The balance sheet is, as of this moment, this is what it showed. Does that make sense, guys? We're not even going to worry about statement of cash flows. Okay? So, not even going to worry about GAAP. Not going to worry about that. There's so much you will learn over so many courses. The most important thing for me is that we gain some understanding in learning these accounting concepts. Okay? So what we're going to do we are going to take a 5-minute